Hi, I can't hear you.
Oh,
Now I can hear you.
okay. I was like, wait a minute. I don't hear you. You can't hear me. How's it going, Ruth? How are you?
I'm good. How are you doing?
Good.
I'm gonna just grab my PowerPoint real quick
Okay.
so that we have it. There we go. We've got 3 people online so far.
Yep. So Dennis and Jameson are with EMR. We got Mike with HVAC distributors. So
Cool. Very good. How you been?
pretty good. We had our apprentice graduation last night, so that's always one of the best events of the night. We had about 250 people celebrating 36 students, which is always really nice to
Yeah, that's
get to
fun.
do that.
Yeah.
So
Yeah, because that's 36 more people that can get in our industry.
yes, that are now going to become licensed journey people. So
Yeah.
I am excited for that, but it's always a long week leading to it. So I'm ready for tomorrow and the
Yes,
weekend.
and this being over and it'll be done.
Yeah.
So yeah. But
Happy
that's
Wednesday. Oh, Thursday, it's not Wednesday. Happy Thursday.
Yes. Don't take that day away from us, Mike.
I want my Wednesday back. I need more time.
Yeah.
well, if you can figure out a way to do that, you're not going to be doing what you're doing now.
Ain't that the truth?
That was fascinating.
It was.
I'm sorry. I was gonna say, I see we have a Rob with us. Is it Rob Brown or Rob Baker? Maybe they stepped away.
Dennis, I'm going to mute.
Oh, there we go. Rob Baker.
Can you hear me?
You can. So let's see. We're just waiting for someone from AJ Michaels and there's Bob Chasen, someone
Bob
from
Chasen
Chasen.
just-
So
Yeah, logged on.
morning, Bob.
Good morning.
All right. Well, since it's 9:59 and we're missing one company, we'll give them another minute or two before we get started. But while we're waiting to see if Mike pops on.
Somebody just popped on.
Oh, someone's there. We have Ruth King with us today, which is a treat. I think judging by past registrations, I think many of you have had an opportunity to attend one of her in-person trainings or when she's come to talk to our dinners, but very excited to have her here for this topic. And I know she has lots of good information for you guys. I'm going to ask if you guys mute yourselves during the presentation so that we don't hear any background. And then maybe at the end, if there's an opportunity or if there's a point that you want them to participate, just let them know to unmute.
Yeah, I have this big question mark. Then you participate.
So, all right. Well, it's 10 o'clock now, so we'll go ahead and get started. So thank you, Ruth.
My pleasure. And thanks to all of you for joining us, especially after last night's dinner. Hopefully that the presentations went well and we have 36 more people who have entered our trade. Yay, very good. Congratulations. I'm going to share my screen and then we can get started. It's really interesting because I presented this to another ACCA state chapter a couple of months ago. And one of the people who was like reticent to come was like, I've been in business, I can't remember how long it was, a lot of years, more than 20, and I still learned something that I wasn't doing right. So my hope for today is that you will find some things that you are saying, okay, I can do this better. Or, we haven't been doing this right, and make the changes that you need to make to do it right. I don't, what I would suggest that you do at the end of this, or as you're going through this, is to look at it from a perspective of, you're not going to be doing all 25 of them. You may be doing one or two of them, and that should be your to-do list after this session is over. Because what happens is, yeah, this is a great idea. This is a great idea. I need to do this. You're going to run and you're going to go do everything you got to do, and you've forgotten about it. So sometime during the session, as we were going through the 25, why don't you just, kind of jot a couple of them down and go, okay, let me check out that one. Let me check out number 4. Let me check out number 18, whatever it is. And then at least you have a thing to go back to when you're finished running around like a chicken with your head cut off. All right. So anyway, thank you again for being with me today, and we will get started. Okay. So let's go. Come on. There we go. In the experience that I have working with contractors for the past, since 1987, most of you absolutely think understanding P&Ls and balance sheets are hard because you didn't grow up in it. You look at it, okay, I have to do this because I need it for business, but it's not something that I really enjoy doing. I hate doing it. I'm not looking forward to doing it. And hopefully by the end of the session, I can change your mind about it. You look at it like this: it's a cobra, it's awful, it's a snake, it's something you really and truly don't want to do, but you have to protect yourself. I really think they're wrong, because I really believe that if you look at it, and I'll give you some examples here about how you can really look at P&Ls and balance sheets and actually have them become fun. And I know that's a word to you right now. Fun and a P&L and balance sheet just don't compute, but it could be like a putty cat. And for the women who are with us, we all, not all of us love cats, but I mean, it's a cute putty cat rather than the big snake that financial statements can be. And I think they're, once I go through a few things, I think you're going to see that they're pretty simple and easy to understand too. All right. What's this? Wiring diagram, right? Or a plumbing outline for those of you who do plumbing and HVAC. Think about the very first time you looked at these and you went, I don't know what this is. I don't know how to deal with this. What's it telling me? And that type of thing. And the thing is that you looked at it and you go, okay, I need to know this so that I can do my job. And so what did you do? You learned it, right? Financial statements are the same thing. First time you look at it, it looks like Greek. I don't know what this is saying. I don't know what this is meaning, but it's just as easy to do it from a standpoint of understanding. Hold on, one more person came in. Understanding P&Ls and balance sheets. It just takes a little bit of time. You learned what the symbols meant. You learned what the lines meant. You learned how to really read the wiring diagrams so that you can do your jobs. Well, it's the same thing with a P&L and a balance sheet. You just learn a few terminology and you spend 10 minutes a month doing it. And within a couple of months, you're going, why did I ever think that this was hard? All right. So analogous to a wiring diagram. Okay. All right. I would bet that everybody who's on this webinar is driving. All right. Think about the first time you got in a car. Other than the fact that, yes, freedom, finally. But think about the first time you ever got in a car. You had to pay attention to everything. You didn't want the radio on. You had to look at this, and this, and it took attention. But after a while, it got to the point where it became reflexive. That's exactly how financial statements can be. But the time you stop paying attention to them, like you stop paying attention in a car and start texting, what happens? You get in a crash. The same thing happens with financials. You stop paying attention to them, you can get in trouble. But it's like, in the beginning, it just takes a little bit of attention, a little bit of time, and it becomes, reflexive at that point. So what we're going to do today is we're going to talk, once you're comfortable with the P&Ls and balance sheets and not looking at it as, oh my gosh, I got to do this, but, as your scorecard every month. We're going to talk about some of the common mistakes that I see, some of the bookkeeping mistakes that I see, some of the marketing mistakes I see, and some of the financials mistakes that I've seen. I've been around in this industry since 1987, and my role and the reason I've been put on this earth is to give you the tools and processes to get and stay profitable, build wealth, and significantly impact your life and the life of your employees. I mean, that's what it's about for me. I love it when the light bulb goes on. These are the books that I've written. What we're going to be talking about today came out of the 101 Dumb Financial Mistakes books. These are my top 25 favorite ones, and we'll go through those today. They're all on Amazon. They're all on Audible. And they're all on Kindle. So they're all electronic if you prefer to listen rather than read. Okay. So let's start with the common mistakes. Number one, this is the most common mistake that I see. And it was interesting. Yesterday, I spent the day with a group of CPAs, and I was teaching them financial analysis. And you're going, why would you teach CPAs financial analysis? Well, they're really good at debits and credits. They're really not good at understanding what the trends of those debits and credits and what they actually mean. And I gave them this very question, how do your clients generate revenue? And, we sell something or they sell something. Yeah, but go deeper. And I said, okay, you have a tire store. How do you generate revenue? They got it. You sell tires. All right. So you want to know for every tire that you sell, how much drops to the bottom line. All right. In our industry, we sell billable hours. So if we don't have billable hours, we can't bill a customer for an hour. We have no service revenue. We have no replacement revenue. We have no maintenance revenue. The only way we generate revenue is through the billable hours of our of our team members who go to our customers. Now, there are a couple of you who are suppliers on here. You generate billable hours through selling product. All right. You don't have the labor issue that we have from that perspective. So just be aware that there are two different ways that everybody in this group, some of you sell it by selling a product, and some of you generate revenue by selling billable labor hours. All right. Now, the product is much more difficult simply because you're going to have product A and product B and product C and product D. And each of those, somebody in your organization needs to know, all right, for every one of these products, how much profit do we earn? And that's a much more complicated Excel spreadsheet than having to worry about billable hours for service maintenance, replacement, plumbing, HVAC, electrical, and things like that. But that's how we generate revenue. All right. So number two, and I'm going to go from the perspective of billable hours, not necessarily product. All right. So number two is you don't track your billable hours. All right. Think about it this way. The first time you figure out, okay, we paid Joe 40 hours for last week. How many of those hours were actually billable to the company or to the customer? You're going to find that Joe had a lot of non-billable time. He went to the gas station. He went to spent a whole bunch of time at Home Depot. He spent a whole bunch of time in supply houses. He spent a whole bunch of time and longer than he should be traveling to jobs. What I normally find when we do this for the first time is that billable hours are around 50 to 60%. Sometimes I see them less than 50%. And the key is to make sure that we want it north of 75%. Okay? So that means if it's 80%, there's only, think about it, if we have a 40-hour week, that's 32 billable hours. When you start tracking billable hours, they get improved. All right. You'll get more billable hours, which means more profit to the bottom line and less overhead cost. So if you want a spreadsheet to track the billable hours, just let me know. I'll have my email address at the end of this session so that, if you want the billable hours template, I'm happy to send it to you. And this is what it looks like. All right. You can do it every week. You can do it for the year. You can do it, however you want. It just comes right straight off your payroll. It takes 5 minutes to do. The thing that's the scary part is the green lines, which are the meeting and training hours, the shop hours, the warranty hours, and the other hours that you pay for that you can't bill a customer for. And they get to be a lot after a while. Okay. All right. Number 3 is abdicating the financial side of your business. If you, first person you hire is a bookkeeper, and you're going, thank goodness I don't have to do anything anymore. The whole financial side of my business is taken care of. That is the first step of getting embezzled from. Because if you abdicate the financial side of business, you're going to get in trouble. And a good embezzler is going to know that you're not paying attention anymore. And they're going to start slowly taking money out of your company once they build the trust. All right. So you can delegate the day-to-day bookkeeping, but you can't abdicate the financial side of your business. You have to get your financials every single month and look at them and review them and figure out what's going on. And there's tools now that can help you do that. And we'll cover some of those by the end too. Okay. So you have to do your statement reviews. Granted, I don't want you necessarily wasting your time doing debits and credits. Let somebody else do that. But you have to oversee, you have to make sure that they're not making mistakes, and you have to make sure that the business is headed in the correct manner. Okay. All right, number 4, thinking that profit is a dirty word. And if you think about it, none of you probably here don't do this for the simple reason is you're here. All right. But think of those contractors who are always the cheapest. You can't sell that for that. You hear that from a lot of contractors who are not part of this group. And they're the ones who probably think that profit's a dirty word. They want to work for wages. Fine, let them do it. But they will get hurt. They will go out of business. They'll run into cash flow problems. You need profit to be able to handle all of those things. Okay. All right, here's my favorite question. Which is more important, cash flow, or profits? Think about that for a second. And I'm not going to ask for a show of hands, but just think what you think is most important. Okay. So we're going to look at this graph. And this graph, the tank, pretend it's not a tank of water, but a tank of cash. There's a spigot going in where we get cash in the door and the level of cash in the tank rises. There's a drain on the bottom where we open that and cash goes out and the level of cash decreases in the tank. So we open the spigot and we get money from collections. It's not revenue, it's actually the collections of those revenues. And, we may sell an asset, we get this much off of interest on our savings account and stuff like that. But if cash were the only thing that was important, we'd never get any cash in because it's not cash flow. All right, so cash in, the spigot would never open, but we still have to pay our bills if we want to stay in business. We have to pay our payroll, we have to pay our rent, have to pay our utility bill. And at some point, the tank would get dry except for a penny, which you have to keep your bank accounts open. And you'd be out of business because you don't have anything to pay your bills with. So it's not necessarily just cash. Now, cash flow, that's really important because the spigot on the top opens, we get cash in, the level rises, we close it at the end of the month, and then we open the drain and we pay our bills. So we're always getting cash in, we get cash out, we get cash in, we get cash out, and up and down and up and down and up and down. But I will tell you a story. So 2 guys back in the 90s started a contracting business. They grew it from 0 to about $2 million, which was a lot of money back then. Never looked at the P&L, never looked at balance sheet. If they had money in their checking account to pay their bills and take their discounts, they were happy campers. So the business grew in 12 years from 0 to $2 million in revenue, and then it hit 2 million and just stopped. The growth absolutely stopped. So within a few months, they were starting to have problems with cash, and they never understood it. There were times they couldn't take their supplier discounts. They were scrounging around for money to make sure they had enough to pay payroll, stuff along those lines, which became really important. And they said, I don't understand this. We've been profitable. We've never had cash problems. So essentially what happened when they called me, which was the smart thing that they did, long story short, they were losing a nickel for every dollar they took in the door for 12 years. And you're saying, well, how does that happen, right? Well, number one, you're not paying attention. So the level of cash is going up and down and up and down, but it's going up 5% less than it should be going up. All right. Think about it this way. As long as the business keeps increasing revenues, the money from collections from one job started the next one. And as long as we keep having more and more and more jobs, you'll never see the decline in cash. But once you start leveling out and stop growing, which they did, you're going to see 5% less cash coming in the door every month, and the level of the tank is going to go down by 5% every single month. So growth masks a lot of cash flow issues. You're in a situation at that point, he goes, well, what do we do? And we actually raised their prices about 10%, no, more than 10% actually. And they ended up very profitable. Customers loved them. And a couple of them called them and said, we didn't think you could charge that little and be in business, which drove them absolutely insane. And the comment was, well, where were you when we started? They weren't ready because they didn't see it. All right. So you have to look at it cash flow, but you have to have profit, positive profit, to be able to have positive cash flow, which gives you the cash. All right. So that's the answer to cash flow, or profit. Profitable sales, which you collect, giving you positive cash flow, which gives you cash. That's the answer. All right. Number 6 is not having a thriving, strong maintenance program. If you want to sell your business at some point in time, or pass it down to your children, relatives, whatever else it is, sell it to one of your employees, you have to have something to sell them. And in our industry, unfortunately or fortunately, it's maintenance programs. The more maintenance you've got, the higher your multiples are going to be. If you have no maintenance, you're probably going to get almost nothing for your business these days. All right, so you just have to be careful with that, because maintenance should be a cultural thing, and it is something that helps you grow. It is something that helps you take care of customers who become loyal to you, and you become loyal to them. This is how I look at our industry. Maintenance is on top, and maintenance gives us service, which also gives us replacement. And obviously service gives replacement, et cetera, et cetera, et cetera. But the key to actually having a thriving, profitable company is maintenance. And it's not maintenance from a standpoint we're making a killing on a profitability, but maintenance gives us the replacements, and maintenance gives us the service. Back in probably late 90s, early 2000s, there was a train distributor or train dealer here, Peachtree Heating and Cooling. They had more than 4,000 maintenance agreements back then. I think they grew it to about 5 or 6 before they actually sold it. 80%, I think it was, somewhere between 70 and 80% of their replacements were on working systems. They had their maintenance customers really tied up and really understanding what they were doing, so that when they became 10 or 12 years old, they automatically just replaced them. But that was the bond between maintenance and replacement. It is a long-term strategy. It's not something that's going to make you a killing tomorrow, but you'll watch it go up and up and up and up. And that's the way I look at our industry, is making sure you have a thriving maintenance program, because it will give you everything else. All right, now, probably a couple of years ago, I had somebody say, well, maintenance is no good. All right, prove it. All right. So for those of you who know me, that I took up the challenge. So I said, if we start with 0 maintenance in year 1, how much can we put away by the end of year 10? So we add 100 a year, which is just 2 a week, which is not a whole lot. Renewal rate is 80%. 100 plans. I just said that they're $180 a piece. I'm only asking you to save half of it. I'm not asking you to save all of it. I asked you to save half of it. So if you look at year 9, yeah. In year 9, you've saved $1,028,363. So tell me maintenance doesn't work. And think about all the replacements you get as a part of it. Think of all the service work you also get as a part of it. Maintenance works. All right. You can do the numbers for the number of replacements you get from maintenance customers. It's generally between 8 and 10% of the number of maintenance plans that you have every year. So, do the math. It works. It absolutely does work. And I've seen it with my clients over and over and over again. A lot of them, that's what they retired on. It's nothing like taking a couple $1 million out of your savings account. Well, at that point, you don't put $2 million in a savings account. It's invested in other ways too, but you walk away with it. Not bad. All right, so let's talk about some bookkeeping mistakes. If you have your wife doing the books because your wife wants to help you with the business, you're doing the books without bookkeeping training, unless she's a bookkeeper or CPA, all right? You need somebody who knows what they're doing. I had a conversation with a guy who finally is getting religion. His wife has screwed up the books so badly. I just gave it to my accountant because I couldn't do it. They were so bad. I didn't know how to fix it without causing humongous tax problems. All right. So get some training. It's kind of like reading the wiring diagram. Once you get what debits and credits are, and it becomes easier and easier and easier to do this. All right. Number 8, financial statement fruit salad. What in the world is that? So think about it this way. I get an email from one of my clients with her P&L and balance sheet for that month saying we lost $80,000 that month. Well, I promise you, if she had lost $80,000 that month, she would have been out of business or pretty close to having no cash, okay? So what had happened was they were planning on doing a really big commercial job the following month, but they ordered the equipment this month and put it on this month's book. So we have all this expense and no revenue. So we have low gross margin, negative gross margins at that point, and negative profit. So that's what I call financial statement fruit salad, is when you have revenue in one month, let's say it's apples, and you have expenses in the other month, let's call it peaches, because I'm in Georgia. You put them together to see what job cost looks like, and you have fruit salad. You have the month with revenue and no expense, you look phenomenal. You have the month with expense and no revenue, it looks terrible. Make sure that you don't have financial statement fruit salad. This is seen when your margins go up and down, like sawtooth, all right? You want consistent gross margins. You want to make sure that everything that's in a month from an expense point has a matching revenue for that particular expense. Okay. All right, negative cash. I go back to my cash flow diagram. You can't have negative cash in the bank because the tank has to have at least 1 penny in it. So that's why we can't have negative cash. Somebody did something wrong. All right. A lot of times what it is bookkeeper prints out all the checks that have to be paid that month, puts them on her desk, and they get paid as the cash comes in to pay the bills. And then at the end of the month, there's still checks sitting on our desk. QuickBooks doesn't know. They assume that all those checks were cashed, so you have negative cash. That's one way of doing it. That's usually the most common of negative cash. Number 10, and I put these together, accounts receivable, payroll taxes, loan payments. None of these should be negative, all right? Negative accounts receivable. If you are on Service Titan, Field Edge, most of our CRM software, you have to tell them to map deposits to a deposit liability account. Otherwise, you will have accounts receivable that are negative. Whenever I see that on a balance sheet, I know they're generally on Service Titan. All right. They do not start you up with mapping this to a deferred income deposit account, which is a current liability on your balance sheet. So you get a deposit for a job. They just think, you got paid for something that you didn't sell yet. Negative receivable. Screws up your books. Because you don't know how much people really owe you if it's negative. I promise you, if you print out an aged receivables report off your balance sheet data, you're going to have a positive number. But on your balance sheet itself, it's negative. All right. That's what's generally going on. You can't have negative payroll taxes either, for the most part. I had one of the publicly traded, I'm not going to tell you which one, payroll company overpay one of my clients' state payroll taxes by $75,000. Took a while to get that one back. So yes, in that particular case, payroll taxes were negative, but that mistake doesn't get done very often. Generally, it's a bookkeeper not knowing how to actually account for what payroll was, because part of payroll is just, withholding. The employee's portion of payroll taxes is withholding from state. If you have state, you've got state tax in Maryland, and federal tax. And then you as an employer pay the exact same amount for the FICA and the Medicare, and you have unemployment. So they take all of that as an expense to you rather than just the part that's yours, and it screws up your payroll taxes. Loan payments, basically what happens is the loan repayment is part principal and part interest. And the interest part goes on your P&L, and the repayment of the principal goes on your balance sheet. Your bookkeeper is just saying all of it's going to your principal repayment. And so at the end of the loan or near the end of the loan, all the interest that was accounted for makes the loan negative. And that's generally what happens there. Get somebody who understands bookkeeping, or make them take a class. I've got a class online for contractors that they can take themselves too. So, or go to a community college, learn it. Okay. All right, here's some sales and marketing ones. All right. This is my favorite one. Gee, this sounds like a really good idea. I think I'm going to do it. You got to do the math. I don't care what it is. You got to do the math. So for example, this is Bruce rule. The break-even revenues are the expense, whatever that expense is, divided by the gross margin. And I mean overhead expense, not cost of goods sold expense. Okay. So the SEO company comes to you, or website company comes to you and says, I want you to pay us $10,000 a month. We're going to do A, B, C, D, E, F, G. All right. And you go, we'll see. All right. Your gross margin's 40%. So we take 10,000 divided by 40%, and that's $25,000. Okay. So you have to, every month, if they're charging you $10,000, have to generate $25,000 to pay for them at a break-even level. And I love going back to them and saying, great, we'd be happy to spend $10,000 with you a month. Are you guaranteeing us we'll generate $25,000 in revenue? Because that's what we need to break even based on what we are spending with you. Well, no, which is always the answer. They're not going to guarantee it. So before you spend any money, divide whatever that is by your gross margin to get the break-even amount of revenue that you have to pay for that particular marketing expense or training expense or whatever it is. All right, again, these are overhead expenses, not cost of goods sold expenses. And does it make sense to you or not? And if it does, do it. If it doesn't, then don't do it. But at least you know how much you have to generate with respect to revenues. All right, so I'm going to do another one. Your digital media wants to charge you $3,000 a month instead of 10. Your gross margin is still 40%. So what are the break-even revenues you need to approve this expense? So we take 3,000 divided by 40%. So it has to generate $7,500 in revenue. Is it or not? It's black and white. It's not, gee, I think it's not a shade of gray. Either it is or it's not. And it also does force you to track it. All right. If you track it and it's not producing $7,500 for you, then you have to have a discussion with your digital media company. On the other hand, if it's generating 25,000 for you and you're spending 3, you're getting a good deal. All right. Just, at least know where the numbers need to be. Number 12 is spending money like manufacturers spend money. All right. And that's basically not marketing from the inside out. So we're small businesses. I mean, we don't have the clout that the big manufacturers have. So we have to be very judicious with our marketing funds. We have to start and say, okay, our clients who are our maintenance agreement clients, our customers, they will pay attention when it's busy, when it's slow, and they're the only ones who are going to pay attention when it's slow. So we market to them first. Then we market to our customers who've used us before, and we get them to do things that make sense to them. We remind them that they need maintenance done, and we try to get them into our maintenance program. So that's where I would go. And then prospect marketing, which is, a lot of replacement marketing is there. Suspect, if you have tons of money, you do suspect marketing. And that's basically what the manufacturers do. General population suspect marketing, because they do radio, TV, all the big media, in Atlanta. If you advertise on the radio stations, the popular radio stations in Atlanta, the signal goes to Chattanooga, which is about 2 hours north, to Valdosta, which is 4 hours south. I mean, you can't, well, you could, but the trip charge to Valdosta would be a lot of money. So, that's why I look at, let's find something that is good for you. Generally, it's with your clients, customers, or some very small geographic area where you have a lot of customers and a lot of maintenance agreements. And think about this the next time somebody says, I want you to advertise on TV. Right? Do the numbers, do Ruth's rule number 2, like we did. All right. Number 13 is to make sure you're marketing at the appropriate times of year. You want to use now a combination of traditional and social media. You don't want to do the advertising that Coke and Pepsi can do to do brand advertising. We have to ask for the order. We are in a situation where we're looking at social media open rates being minuscule, and a lot of things are switching back to direct mail. And think about how much or how little you get in your mailbox these days. If you did something that was very bright and very cute, to the woman who's going to be going to the mailbox, more so than the guys, they'll pay attention to it because there's not a whole lot in their mailbox. I mean, there are days I don't even get mail anymore. So if I got one of those, bright colored envelopes or bright big postcards with something that made sense to me, I'd probably read it at this point. So the pendulum is starting to swing back the direct mail way because the open rates are higher than they are in social media right now. Text advertising, probably only for your maintenance clients and people who have approved you texting them. Okay. All right. This is the one that drives me absolutely insane. You've done a 10, 15, 20,000, 30,000, whatever job for a customer. And it can be commercial, it could be residential. Your salesperson just goes to the next one and forgets about the one you just did, where the customer wrote you a big check. The best referrals you can get are from these people. So 30 days after the sale, salesperson, and in a lot of cases, I have somebody from the office calling because salespeople won't do it. Calling Mrs. Jones, Mrs. Jones, this is Ruth with ABC Heating and Air. We installed your X about a month ago. How's it going? And you listen. Hopefully everything's working well, et cetera, et cetera, et cetera. Terrific, glad to hear it. And if there is something wrong, guess what? You get to get out there and fix it without the customer at that point giving you negative, nasty reviews or so will never use you again. By the way, and ask the question this way, by the way, who have you talked to about your new whatever? Not do you know anybody? but who have you talked to about? All right, they'll start thinking of the conversations that they have. If you ask, do you know anybody? They go blank because nobody comes to mind. But there is not a human being on the face of this earth, well, in the US anyway, who doesn't spend thousands and thousands of dollars and tell no one. They told their mother, they told their neighbors who may have seen your trucks, they told the people they go to church with. I mean, they told somebody. We are human, we are social. When we spend money, we tell people. All right. This is the best way to get referrals. And it works. Number 15, having a warehouse supermarket, which means you don't have your warehouse locked up. You don't have your parts room locked up. Or if there's a lock on the parts room, the lock is always open. What's the difference? All right. Material lists should be done for your jobs. Materials should be pulled for your jobs. They should not be able to take 3 when they need 1. They truly need to be able to be in a situation where they should take what's on their material lists. Inventory is a bet. You've got your hard-earned money tied up. Go look at how much is in your warehouse when we get done. A lot. All right, here's the question. If you can't inventory and it's $5,000 less on your balance sheet and your net profit is 8%, what revenues do you need to generate to pay for the loss? 5,000 doesn't seem like a whole lot, but you have to generate $62,500 to pay for the $5,000 loss in inventory. A lot of money. It's a lot of money. And you can multiply this by 10, 15, whatever the number is versus what you count at the end of the year. The numbers get staggering after a while. Okay. All right, let's do some that are financial also. Looking at your bank statements online every day is like brushing your teeth, okay? It's the first line of defense in anything, all right? You're gonna see things that are going on with your statement, and you may see things that don't make any sense to you, and I'll give you an example here. One of my clients assigned his bookkeeper to go and look at the bank statement every day, which he did. And one day he noticed 2 little deposits that you get, like 22 cents and 82 cents or 87 cents or whatever. Thought, the owner's setting up a new account. We're busy. He just forgot to tell me. Wrong. Next day, bank calls. Did you authorize 2 $25,000 withdrawals? No. This was a random number generator just making sure that there was money in that checking account, and then they try to pull the money out. They were probably somewhere in the, in Russia or, Ukraine or wherever the bad guys are these days. But it's really easy to do that. It's very easy to get the bank routing numbers and how many digits there are in account numbers, and they just do random number generators. Real easy. Look at your bank statements every day online. It is your first line of defense. It takes you less than 5 minutes. But you'll figure out and you'll see everything that's going on with your accounts. Okay. So you never know who's stealing from you. Any of these people can be stealing from you. And my favorite story is the one of the nuns, all right? About 5 years ago, 3 nuns were arrested for embezzling about $500,000 to go to Las Vegas and gamble. True story. Hit all the news. And what they had done is there were 2 checking accounts for the school. And since the school was always profitable, nobody ever bothered to look. Okay, so don't be profitable and not look. And the other account was pretty much dormant. So they basically had the same names too. So most of the tuition checks would go into the real operating account, and they'd take 1 or 2 of them and put them in their separate account and use it to, take the money out at that point. So the only way they got caught was that there was a new administration and they did a complete audit, and that's how they were caught. Well, nothing ever happened from it, and I figured that the Catholic Church buried it. But about 18 months ago, they got thrown in jail. They got convicted and put in jail. So, if a nun can steal, anybody can steal. That's the way I look at it. You just never, ever, ever know. Okay. look at your statements every single month. And I don't mean look at January statement in April. It doesn't do you any good to look at January statements in April. You should have your statements by the 15th of the month, every single month. At this point, since almost everything is electronic, you can look at your bank statements online and reconcile your bank statements. You can do all your credit card statements online. You can do most of your vendor statements online. There's no reason in the world you should have anything later than the 15th of the month. Don't put up with that particular excuse. All right. When you're doing your analysis, look at liquidity, and we don't have time today. And I think in some of the sessions that we've done over the years, I've told you more and more about these, but liquidity ratios, which basically tell you, can you pay your bills, and can you, is your profitability increasing or decreasing? Are you taking on too much debt? How much are you spending on payroll and payroll taxes for every dollar that comes in the door? And then usage is receivable days and inventory days. Okay. So from the time you send out an invoice to a customer, how many days do you get paid on average? From the time you buy a part, on average, how many days is it till you use it? Okay. So print out a vendor list every quarter. You print it out. You want to make sure there's no ABC Inc. and ABC Company and ABC Corp. Somebody stealing from you normally when that's happening. Okay. Number 20, no bookkeeper should sign checks. Nah, they shouldn't, unless it's your wife. And if it's your wife, don't get a divorce. All right. So husband and wife own a business together. For whatever reason, he never let her have check signing authorities, but she was responsible for payroll. And it was a really nasty divorce, and she decided she was going to get her husband, so she didn't pay payroll taxes for a year. IRS came after him because she didn't have check signing authority, couldn't come after her. It was his responsibility. That hurt a lot. So if I were a bookkeeper, I wouldn't want to sign checks, simply because if something ever happened with the IRS or the state or your sales tax organization, anybody who signs checks, they can go after. It's also one of the things that you look at from a standpoint of making sure that the bookkeeper doesn't sign checks to herself. And you never look at it because you're not looking at the reconciliation reports. You got to do this. It does not take long. Just do it. Gross margins really don't matter. You got to know your overhead cost per hour and your net profit per hour. And this is a graph of 20, I think it's 20, jobs of a former client of mine, and selling price, GP is gross profit, GM is gross margin, OH per hour is the cost of overhead. They have to add for every billable hour $60.20. Number of hours, the net profit, which is the overhead per hour times the number of hours subtracted from your gross profit, and then your net profit per hour. Okay. So we have two 40% gross margin jobs. One earned $73.83 an hour. The other, they paid a customer $21.68 for every hour they're on that job. This is why we don't totally rely on gross margins. We have to do job costing. Okay. Here are two others, a 64.5% gross margin where you think you made a killing and you made $50, which is less than the 40%. And then you had the 19.41%, which you thought you lost your butt and you actually made more than the 64. So margins don't tell us the whole story. Make sure you actually do the job costing based on your overhead cost per hour and your net profit per hour. Okay. All right, number 22 is your weekly cash flow reports. That's what one looks like. Your bookkeeper should put this on your desk every Friday afternoon is the last thing she does for the week. And you should know what came in. Basically, that graph I did with the tank of cash, that's the tank of cash in a document. And then you estimate what you need for next week. Behind this goes the age receivables and age payables, which you should also look at. Make sure that everything is in. And if there's bills you want paid, you can circle them and she can prepare the checks and the paperwork behind the checks and put it on your desk for signature. And if you can see collection issues, you can circle them and say, start collecting and making collection calls. And that way you can track what's coming in and what's going out at the same time. Number 23 is not saving 1% of every dollar that comes in the door. It's not going to kill you. You can still operate your business on the other 99%. And then I showed you the thing about saving 50% of the maintenance money. Just do it. Get in the habit of doing it. You know, I can't remember how many of my clients, when COVID started, either emailed me or called me and said, I'm so glad you made me put money away every time we get money in the door, because I don't have to worry. And this was before PPP was enacted and all that sort of fun stuff. But they didn't have to worry. They had nothing in their savings account to survive. All right. 24 is matching your AR and AP aging reports against the values on the balance sheet. If they do not match, so if your aging receivables report says 100,000 and on your balance sheet it says 89,000, somebody's stealing from you. That's most likely what's happening. Same with AP. Okay, make sure that they match what's on the balance sheet against what's the total on your aging reports. They match or should match exactly. And then number 25 is not sending your bank statements home. Yeah, but you're looking at your bank accounts every single day. But sending your bank statement home, you can miss something looking at it, but you'll also see all the correspondence, all the checks that got bounced, all the payments that weren't made, you know, whatever else it is. You can keep track of your bank accounts pretty easily now, because almost nothing goes to your mailbox. So just do it. It takes 5 minutes to review everything. Okay. So those are the 25. And if you want more, there's 2 things that you can do. One of which is financiallyfit.business, and the other is a free financial statement checkup if you'd like it. If you want us, you know, I'm happy to look at your financials. Not costing you anything. If you do, send me your 2023 year-end P&L and balance sheet. Accrual basis, not cash basis. Can't do anything on a cash basis. It needs to be on accrual. And then if you want to look at what's going on a monthly basis pretty easily, you can go to financiallyfit.business. There's the QR code for it. We finished the AI so that it actually does read your financial statements. We're working on the AI right now that will do the interpretation for you so that you don't have to look at the graphs yourself. It will tell you what it's saying. And then by February of next year, we will have here's yours and here's everybody else's in your industry. So you can compare you against everybody else who's using the system. But that will be next. We'll have that done probably by next March is our goal for that. But check it out, take a look at it. If you want a free checkup, happy to do that also. And that's my thanks to you for attending today. If you have questions, it is now the time for questions. Anybody got questions?
No.
I don't see any hands.
Okay,
No.
cool.
Rob, did you have a question? I saw you unmuted, I think.
Oh, no, no, I didn't mean to do that.
Okay.
All right, sounds cool. All right, so email me if you want. It's rking@financiallyfit.business. I'm happy to take a look at your P&Ls and balance sheet if you would like me to, or if you'd like the weekly cash flow report, or you would like the billable hour percentage graph that I showed you. I'm happy to send you whatever was in these slides because it will help you. All right, so I appreciate your time this morning.
Thank you so much, Ruth, for your
Profitable day.
time. Thank you.
Thank
Bye.
you.
Thank you.
Thank you.
See ya.